Coming up in today's show, Tesla shares rise almost 7% after deliveries come in much higher than expected. US manufacturing shrinks by the most in 3 years. A hedge fund manager who thinks the Fed's balance sheet will double to $16 trillion in coming years. Wall Street bulls increase their year-end price targets. BlackRock refiles its Bitcoin ETF application with the SEC. And the cannabis ETF finishes up 8.6% today. Welcome back to Click Capital, everybody. I hope you had a great weekend. My name's Jared, and if you're new to this channel, hit that subscribe button as I do a daily market review every day after market close, taking you through all the most important data, news, events, and charts to keep you updated on what's happening across all financial markets. And so we had a shortened trading day today in US markets. The markets normally open 9:30 a.m. to 4 p.m. New York time, Monday to Friday. However, we closed at 1 p.m. today, and that's going into the 4th of July holiday tomorrow when US markets are shut for the whole day. And so it was a bit of a mixed day to start this shortened trading week. We did see a little bit of green across the board. A few of the mega cap techs pulled back, a bit of weakness in healthcare, and we got a little pop up in the banks. But the biggest news out today was Tesla coming in with second quarter deliveries of cars higher than expected. So analysts were expecting 445,000. They actually beat that by 20,000 and delivered 466,000 cars in the quarter. And once again, Elon Musk and Tesla proves the skeptics wrong. And for a company of this size, I think a lot of people are still underestimating its growth. So we just came in with 466,000 deliveries in Q2. And Q2 last year was 254,000. So that's growth of over 80% year over year, which is a huge number for a company the size of Tesla. And helping that is Model 3 and Y are now eligible for a $7,500 tax credit in the US under the Inflation Reduction Act. And those are the big sellers. So 96% of deliveries reported in the second quarter were its Model Y crossover and the Model 3 entry level. And don't forget, we also may be getting the Cybertruck later this year, which could get the market really excited going into that. And so the market just loved that. We broke out to new year-to-date highs, got up over 284 a share before we finished just under 280 a share. That was on lower volume, but you got to remember, when we jump up really high, it doesn't have to do as much volume to be the same daily traded value as back here. Plus, it was a shortened trading day, like I said before. We finished at 1 p.m. today. And typically, the 4th of July trading week is a bit of a quiet week in the markets overall. So technically speaking, we're still a little stretched here on these bearish divergences. But what overwhelms technical divergences is strong news reports like the one we got today. So I wouldn't be shorting Tesla here. In fact, I never short Tesla. I'm actually a long-term owner in the stock, and I just seek to trade around my core position. So for now, I'm not doing anything. And if the market continues to hold up, I wouldn't be surprised to see Tesla back over $300 a share any day or week now. And just taking you out to a weekly chart on Tesla, that $300 zone is a point where price has turned a few times before, going back to early 2021 and as a big psychological level. So I'd expect that level to act as a bit of a magnet, and it'll probably stall out and consolidate there. Or if the market's still ripping higher and we get any news of the Cybertruck, then we may just break right through it and head back to all-time highs just below 420. Another news out today, we had US manufacturing activity readings come in and a lot lower than expected, showing that the manufacturing sector is still in a recession and contracting. And once again, just more bifurcation in economic data out there. So the S&P Global Manufacturing PMI came in at 46.3. ISM Manufacturing Employment came in at 48, and the manufacturing PMI came in at 46. So anything below 50 shows the sector is contracting. And once again, this can be another sign of potential upcoming economic weakness. So tomorrow's a public holiday in the States. We don't have any data coming out. We've got the FOMC minutes on Wednesday. Shouldn't be any surprises in there. Then on Thursday and Friday, we've got a bunch of jobs data I'll be looking at. Starting off with the ADP employment change, the weekly initial jobless claims. We got some services PMIs coming out, JOLTS job openings, and then into Friday, the big one, non-farm payrolls and the unemployment rate. So the consensus on that is 3.6%. And I'm really watching this number, as in my opinion, if that gets closer to 4 or above 4 in the upcoming months, then that can really indicate the recession's just around the corner. However, what could keep the market ripping into a recession is like this hedge fund manager, Michael Howell, is proposing a theory that we should forget about quantitative tightening and the assumption the Fed wants to get their balance sheet back down, which we can see in this chart here is currently at about 8.3 trillion. And that peaked out about a year ago, just below 9 $1.9 trillion. And this balance sheet's absolutely ballooned, especially since the GFC, then just went into overdrive mode, going into COVID lockdowns, as what the Fed does is they basically create artificial money. Then they go into the market and buy all sorts of securities and assets, things like MBS, mortgage-backed securities, even state-issued municipal bonds, and so on and so forth. And so what they do is provide a lot of artificial liquidity to the system, and that helps to keep markets propped up. But they do it under the guise of saying they wish to keep credit open to small businesses. And this is how they artificially manipulate markets. And so the theory this guy is proposing is that there's so much debt out there in the system, consumer, business, and government debts at all-time highs. And so when we eventually do go into a recession, which could still be at least 6 months, maybe 12 months or even more away, he's saying the Fed is going to have to go back to quantitative easing and start buying massive amounts of bonds again. And so he goes on to say, investors should therefore expect a continuing tailwind from global liquidity instead of last year's severe headwinds. This should prove good for stocks, but less positive for bond investors. And he's saying in coming years, they'll probably have to bail out debt-burdened governments as well. And so here's a look at a long-term chart of the NASDAQ index. And this huge move up we've had since GFC correlates really well with the Fed's balance sheet. So all that funny money in the system. And so we've kind of been in this type of environment where good news is good. If the economy is expanding, corporate earnings are expanding, that's good. That's a good, solid, logical reason why stock prices should go higher. But now it could also be that bad news is good, because when things get bad, then the Fed's going to step in and dump a ton of liquidity in the system to keep things propped up. So even though in the last 20 years, the NASDAQ stock market went up about 2,400%, which you look back in market history, is one of the most extreme run-ups in a 20-year period, similar to the Japanese Nikkei in the late 80s, before it collapsed 80% over the subsequent 20 years. However, if this guy's right and the Fed do indeed double their balance sheet over the next couple of years, and we truly do go into this clown world, then for sure it's possible that the market could even keep going up to crazy new highs until something really breaks and the whole thing falls apart like a house of cards. And that's why at the end of the day, you just got to respect the price action, because no matter how bad the macro backdrop is, if the market's really just leaning against the Fed and all these big algorithms know good news is good, bad news is even better, then for sure they could just keep pushing this thing higher and higher and even look forward to some bad news happening. Which I know all that is a bit crazy to think and just doesn't make sense and just pushes us further and further away from economic reality. However, it's already kind of happened. This was back in early 2020 when we got COVID. So the world went into a lockdown. The market sold off very quickly, but it only went down for just about a month before the Fed stepped in a record way we've never seen before, and then look what happened over the next year. That's not a coincidence. That's the Fed liquidity-induced rally on top of taking rates down to near zero. And unfortunately, the biggest end result of that is it just widens the wealth inequality gap, because 90% of the stock market is owned by the top 10% wealthiest people, and especially the top 1% who saw their net wealth absolutely explode higher after COVID. And so according to the stock market, a global pandemic is a great thing because we got that huge liquidity. And then of course with all that came the inflation, and then the Fed had to reverse course and increase rates, go to quantitative tightening, and then of course the stock market didn't like that at all. Then it found a bottom in mid-October. We had a bit of a technical bounce, and then ChatGPT came out, and then the market's gone crazy for AI. And the Fed's kind of neutral with their balance sheet. They've pulled back a bit on the tightening, and obviously rates are still going higher, which the stock market's completely ignoring as well. So I hate to use the term it's different this time. However, if that fund manager is right and the Fed just goes into even more crazy levels with their liquidity and balance sheet, then for sure this thing could melt up. We could see the NASDAQ at 30,000 regardless of what the economic data is. But it would be nice to think at some point we do get back to economic reality. But who knows, maybe last year wasn't even a bear market, but simply a correction in this huge secular bull. And since anything is possible in the markets, we may need to see a true blow off top up to crazy levels before most of the public catches on to what the Fed is actually doing and how it affects them. And then it becomes a big political issue and everything reverses course. But at the end of the day, along with everyone else out there, even the billionaires, don't know exactly how this is all going to play out. One thing for sure, it is interesting watching it all and can just make it challenging for us traders and investors. All we've really got to go on is historical data and patterns, but the Fed could be smashing those apart. Other bulls on Wall Street, like FundStrat's Tom Lee, has got other reasons why he thinks the stock market is headed to record highs this year. He actually just increased his year-end price target to 48.25 on the S&P 500. And he's saying we've had a huge decline in inflation. The inflation war is the war the Fed is waging and seemingly winning. He also went on to say stock market valuations are not demanding and a potential boom in productivity thanks to artificial intelligence. He expects headline inflation to get down to 3% by the end of the year, and that could propel stock prices higher as investors begin allocating their 5.5 trillion cash pile back into equities. And he pointed out the forward price to earnings ratio of the S&P 500 excluding mega cap tech stocks was 15.7 at the start of the year and now stands at 16.4, which is a little bit below the historical average level. He went on to say AI could be the start of a super cycle. Sharing a similar sentiment is the always interesting Jeremy Siegel, professor from Wharton, who also says the bull run in stocks can go on a lot longer even as the Fed wages war on growth. And he's pointing out the momentum, S&P 500 up 16% year to date, is really strong in the market. He did admit there is downside risks in the second half of the year, with the US facing a potential recession. And he also pointed to the hype in AI and bets that the Federal Reserve will soon pull back on interest rates. However, contrasting that view is the co-chief investor from one of the largest hedge funds in the world, Bridgewater. And that's Greg Jensen, who says be ready for stocks to stumble and recession to strike. He says markets aren't pricing in inflation and growth risks. And he said huge amounts of government spending have dulled the impact of interest rate hikes. However, the government is largely putting a pause on most of their spending. So he went on to say many investors are betting inflation will fade, the Fed will slash interest rates, the US economy won't skip a beat, stocks will keep marching upwards. But he said they shouldn't rule out a recession and slump in asset prices. He thinks growth and inflation will disappoint and that higher rates should eventually take their usual toll. And here's an interesting chart I wanted to share with you guys today. And that shows AI-related stocks drove virtually all of the S&P 500 returns this year. So this red line's the S&P 500, and then this grey line is the S&P excluding AI boom stocks. And you can see that's pretty much been flat. So most stocks have been sideways or in downtrends this year, and it's really just the Magnificent Seven, those large mega cap stocks that's really pulled the S&P 500 and NASDAQ indices higher. And what can be thought of as a skinny bull run. Typically not a sign of a strong sustaining bull market. In other news out today, we had BlackRock refile their Bitcoin ETF application as the SEC previously deemed it lacking. So it looks like they're serious about getting this through. They're not going to give up on it. They're going to pull out all the stops and try and be the first to market on the first spot Bitcoin ETF that'll closely track the price of Bitcoin, and it should be quite the popular one if they do get it in. And a bunch of others have followed suit as well, like Fidelity and a few other smaller ETF managers have put in applications to open theirs as well. And since BlackRock plans on using Coinbase as the custodian of those Bitcoin assets, the market for Coinbase shares today really liked that news with BlackRock coming back after the SEC pushed back last week. And we saw Coinbase rally up 11% today and trading at $80 a share in after hours. Didn't see the same huge rip in the price of Bitcoin itself, although we are sitting above 31,000 a coin here. And like I've been saying for the last week, I think these reversal signals are going to fail and we are going to rip higher above this big $30,000 resistance zone. Let's look at Fed Fund futures pricing in an 86% chance the Fed will hike later on this month. The fear and greed index has just gone diabolical now at a huge 85, reading the highest we've been in years. And we spent all of June over 70. And so sentiment in the stock market has been as elevated as it has been since late 2021 when the market peaked out. And that's largely due to the options market. So a really quiet day, been a half day here, 20 million contracts traded. But look at that, 61% of them were calls. And so investors are loading into the likes of Tesla, the put percentage at 38%. JP Morgan was a big one today with huge amount of calls, 220,000 contracts, given a really low put percentage of 13%. And others like Amazon, 26%, and a few other mega cap techs in the 40s and 30s. Got a little bit of jump in the buying activity of dark pool traders, still slightly in bullish territory here. They had been pulling back for these last couple of weeks. However, I don't think we can read too much into this being a half day and really light trading volume. And corporate insiders still selling a bit more stock than they're buying. Okay, back into the charts, and we've got the S&P 500 at 44.55. And for those of you who don't know, I use my own custom indicators to interpret and analyze the markets and find trading opportunities. And so if you'd like to learn more about these indicators, click the link in the description below this video. And it'll take you to a page on my website and you can watch the video there that goes over each of the 20 indicators and explains them in detail and how you can use them as well. So you can see on our DSI indicator and hidden divergence, we do have these bearish divergences in the market. We've got the NASDAQ pretty much sitting at year-to-date highs and most of the indices are still in overbought levels. And we can see that on our S&P 500 oscillator still at 59 here. indicating the market is a bit overbought in the short term. Not too much to report in international stock indices, kind of all sitting there on this quiet trading day. Not too much going on in volatility land, VIX sitting at 13.5. So normally these trading weeks around holidays are normally pretty quiet, low trading volumes. Not much normally happens. We can get some funny business, some weird moves. However, most of the time things are pretty quiet. And because of all that call buying, that's making that put-call ratio in equities super low at 0.66. And short-term breadth is really strong as well. Almost 85% of stocks above their 20-day average. Growth versus defensive sectors still ticking higher. We've got the 10-year, 2-year yield curve at record inverted levels here. Inflation expectations continue to tick higher. So does the US government bond 2-year yield. The US dollar still sitting at 102. Commodities were also flat today. And the best performing sector today was the cannabis ETF. And for those of you who watch my videos every day, you know 2 weeks ago, I shared with you I took a long position in the cannabis ETF as a tactical medium-term position, as I'm speculating that the SAFE Banking Act has its best chance ever pass in the Senate and make it to Biden's desk for signing in a month or so. And so I couldn't see much news out today as why we got this move. There was news out from Canopy Growth that they plan to minimize their cash burn. However, the MSOS ETF that I own doesn't even hold shares in this, and this looks like a dead cat bounce after it's been absolutely smashed down. Probably just a bit of short covering there, and that may have helped the rest of the sector. However, these are the top 10 holdings in MSOS, and they all had some pretty good moves up today. And so I'm speculating that someone might just know that the Safe Banking Act is probably going to go through, and maybe on this quiet trading day in this shortened trading week, where not many people are around and watching things, they may be just getting ready and sneaking in there. So hopefully this is the start of a bigger move, and even though we had a half trading day today, we still put in more than average volume, unlike the rest of the market. So I'm looking for at least a double on this thing, because if SAFE does go through, this could rip up to, who knows, even $20 a unit. And like I said 2 weeks ago, I just thought it was a real asymmetrical bet with much more upside than downside. Looking across other stock sectors today, mostly green across the board. There's ARK trading up 2.2% since it owns Tesla. Consumer discretionary stocks continue to find new highs for the year. A little bit of a pullback in the home builders after we've had such a great run. Regional banks continuing just to hold on to their 50-day VWAP, and a bit of weakness in the healthcare sector, and there's utilities perking back up. And just a bit of a bird's eye view heat map of all the sectors using our sector trends table indicator. And so we can see right now in the medium term, most sectors are above their 5-day moving average, and pretty much the same thing in all other time frames as well. Over to popular stocks, we've got BlackRock ticking up a little higher. There's another look at Tesla, just trading at 278. In post-market hours. NVDA still calling up on these bearish divergences, and a little bit of a retreat in the mega cap techs, Apple, Microsoft, and Amazon today. Bit of green across the meme stock space, and not too much else exciting to report in the market today, with Charles Schwab continuing to trade well. And that wraps it up for today. I'm still market neutral in this environment. Like I said, I think we're really extended here in the short term. However, you can't argue with this momentum in the medium term. There is quite a lot of bullish momentum out there. And that wraps it up. If you found value in this video, I appreciate you hit the like button. If you haven't already, hit subscribe, so these daily videos show up on your YouTube homepage every day when you log in. And I'll keep doing my best to keep you updated on exactly what's going on across the markets and how I'm trading them. And so US markets are closed tomorrow for the 4th of July holiday. Just want to wish all my American friends happy holiday. I hope you enjoy your day off, and I look forward to seeing you all again on Wednesday afternoon when the markets open back up. All right, guys, take care, and I'll see you then.